Please make sure to subscribe. What is a relative valuation? A relative valuation relies on the use of ratios in comparable industries and asset classes. The relative valuation approach estimates the value of an asset using ratios. The ratio is determined based on price and on the specified relevant measure. The key assumption of the relative valuation approach is that assets in the same industry with similar risk and returns should have similar outlooks depending on the ratios used. There are a series of ratios that are used to determine if an asset is undervalued or overvalued. Let us keep in mind that the focus is on finding value, and that means that the interpretation of these ratios is going to be different in comparison to growth-oriented investors. One ratio commonly used in relative valuation for stocks is the price-to-earnings ratio, which is the ratio of a company's stock price divided by its earning per share. For instance, a publicly traded company that generates annual earnings per share of $1 and is trading at $12 per share has a P/E ratio of 12. In other words, a P/E ratio of 12 suggests that investors are willing to pay $12 for every $1 of earnings that the company generates. The higher the P/E ratio, the more expensive the stock, and the lower the P/E ratio, the cheaper the stock. A common ratio in the real estate industry is the cap rate ratio. It is the ratio of a rental property's net operating income divided by the purchase price. For example, if an investment property costs $1 million and it generates $75,000 of NOI, net operating income, a year, then that is a 7.5% cap rate. Usually different cap rates represent different levels of risk. A low cap rate implies lower risk. Higher cap rate implies higher risk. The key is to focus on the metrics that matter most to that specific industry or asset. Also, keep in mind that each metric conveys a different meaning, and each one should be understood in order to determine if the asset is undervalued or overvalued. Please make sure to subscribe, like, and comment. We will see you soon in our next video.